Welcome back to another episode of Retire Right. I am Ron Wyatt. Today I am joined by the Geek Squad here at the company, or the investment committee, I guess is the more formal term. Ron Wyatt and Nick Lewandowski. Gentlemen, how are you today?
Very well. How are you, Ron?
Good. I'm doing well,
great.
Thanks. The focus of today's episode is going to be pretty much strictly internal. It's going to be investment focused in nature. We're actually going to talk about Wyze Design Direct, which is the stock strategy that we manage completely in-house. Ron created this, I think it was between 10 and 11 years ago, and he's been running it since. A lot of our clients really like this strategy. Some of the things that they say is that it's unique. They're not finding it in other places. They've been happy with the returns, et cetera. So I want to start just kind of like maybe painting the picture of what brought us to where we're at now. Ron, you created it obviously. So can you just give us some background and some history as to like where you were at in your career, maybe that led you down the path of exploring this as an opportunity and then actually acting on it?
So my objective is for the clients to produce good risk-adjusted returns.
Which means?
So let's just say you have two portfolios that give a 10% return. Mm-hmm. You'd rather have the portfolio that fluctuates less.
Got it. Okay.
So that's my objective. Now, also, I'm very passionate. I read the stuff all the time, and I'm competitive, so I like to outperform. Okay. So that's what led me to it.
Okay. How's it been working?
It's been working very, very well.
Okay.
Yeah.
So, which essentially means the return for the given level of risk has been favorable. Got it. Is there any other like important information or details you'd want to share just for from a historical perspective as to what led you to creating the strategy? Sure.
So I know what the research shows us, and it was really just a matter of taking that research and finding some logical way to put it all together. Okay. So let's focus first on the research. So there's something you can call it drivers of higher expected returns. You can call them factors of higher expected returns. But let me just give you some examples. Okay. So let's just say that you have two companies that are equally as profitable. Now, profitable is defined as how much profits are you getting from the assets you have, right? Mm-hmm. And valuation is how much are you paying for what you're getting? How much are you paying for the earnings? How much are you paying for the sales, right? And so if you have two companies with the same level of profitability, you'd rather buy the company that's cheaper, that's has a cheaper valuation. On the flip side, if these two companies have the same valuation, you'd rather buy the company that has a higher profitability, a level of profitability. Okay, those are the two primary drivers in the strategy. There's some other factors too, which we'll get into in a little bit. But Nick, would you share, please, why these are the two primary factors?
Yeah. So for a long time, researchers have been saying, hey, can we build like a statistical model to explain asset returns or stock market returns? And like Ron was just saying, profitability and valuation are basically in the body of research the two most impactful ones that have been identified in the research. And some data to support that. This is from Dimensional Advisors, which is the fund company that we use on the ETF side for our strategies. They looked at data from 1963 to 2022. So It's a very nice data set, covers a long period of time.
Excuse me, you know that we have to be the Geek Squad if he says it's a nice data set. Go ahead, I'm sorry.
It's a beautiful data set. That's good. So they looked at this data, and they looked at the returns of different segments of companies when you kind of mapped how profitable are they versus their valuation, right? So just to give you a sense of how that shakes out, when they looked at for large companies, large stocks, the least profitable companies that were the most expensive according to valuation over that period returned about 9% over that time period annually.
Okay.
And you're like, 9%, yeah, that sounds pretty good, actually, if you know much about average market returns. But then you line that up against what did the highest profitable and least expensive companies return. That set of companies over that period returned 15% annually. So it's like a 6% difference.
Oh, wow. Okay.
The effect is even more dramatic when you look at small companies. So same time period, same criteria, except we're looking at small companies instead of big companies. The least attractive in terms of being very expensive and not very profitable only returned 4.16% over that time period. The most attractive companies returned about 20% annually. So the spread there in small companies was about 15, 16%.
Okay, so let me make sure that I'm keeping up with you guys here so far. So Ron, you were seeking better risk-adjusted returns for your clients. That's what led you down the path of creating the strategy. The research shows that there's certain, whatever word you want to use, factors or drivers of better or higher expected returns. Nick, so far you've referenced the size of the company. So you were comparing smaller companies to larger companies. You were talking about valuation. So cheaper tends to be better than more expensive stocks. And you were talking about profitability. So is that how it works? You're just targeting those drivers? Like, can you take it a step further and explain like how it's actually built, how those all tie together?
So that's 80% of the portfolio. 20% of it is we're using risk, because studies show, surprisingly, that super high risk companies actually don't have higher expected returns. Actually, it's lower. And so all things being equal, we'd rather have less risk. So that's part of the weighting scheme. And lastly, we're looking at projected revenue growth, right?
Okay.
All things being equal, you'd like the company to be reasonably valued, very profitable, low risk, and growing very nicely, right? Perfect company doesn't exist, but we try to do as much as we can to get great companies in the portfolio.
So take that one step further for me and just try to really simply explain, and I know this is technical in nature, but just try to keep it high level if you can. How do you take all those factors and then begin building the portfolio from there?
So what we'll do is, like for valuation, we have six different metrics. I mentioned like how much you're paying for the book value, the assets.
Book value is just
assets minus liabilities, right?
But book value is a metric. It's just a technical metric. We don't really need to focus on what that means.
Exactly. How much you're paying for the sales, how much you're paying. So it's basically the valuation, how much you're paying for what you're getting, right?
Okay.
Profitability, I already explained. So we take multiple metrics for valuation. We basically average them together, do a percentile rank. So what it means is 100 is best. So low valuation is 100, expensive is 0, right? We do same profitability. The most profitable companies are at 100 and the least are at 0, okay? So then we also do that risk rating. Low risk companies are 100, and then high growth companies. So what we do is we rank those all together, and we average those together, do a percentile rank, so that we can look at the most favorable to the least favorable companies. So it's just a weighting scheme. Okay. Now, on top of that, we do a lot of things to screen out potential danger. For example, we won't consider buying any companies that are in the worst 5% of risk, right? Momentum. If a company is falling, maybe it's temporarily falling to come back, or maybe it's going to continue to fall. So we try not to catch the proverbial falling knife, right? We're not trying to catch it. So if the momentum is really, really poor, we won't touch it until it gets to be not poor. Okay?
Well, so how do you get into that momentum decision making without predicting? Like, how do you know if something's falling and it's going to continue to fall, or vice versa?
You don't know, but what you don't want to do is buy a company and it continue to fall. So what will happen is that where we're using the momentum is really when we're buying a stock, is making sure that the market's saying, hey, it's okay. There's not a problem with the sector or the company. That's all it is.
I should emphasize, just like we talked about metrics, like hard metrics for valuation and profitability, momentum has those same metrics that apply to it. This isn't just like Nick and Ron being like, whoa, it went down a lot today, I don't think we should buy it. Right. There's like a quantitative process behind it that's systematic.
What has done poorly now is probably likely to do poorly for the next 6 months to a year, depending on circumstances. So what will happen is, if a group of stocks are performing very, very poorly, we don't need to be in a rush to buy them. We can wait a little bit until they start to kind of level off a little bit, okay? So we also have things in there to protect us, making sure there's not a risk of bankruptcy, making sure the earnings aren't being managed too aggressively. We have a lot of other things in there to make sure the data is very, very clean.
So correct me if I'm wrong here. So the way that it's built, or how it works in a nutshell, is there's certain factors of higher expected return. So we talked about, smaller companies tend to do better than larger companies. Cheaper companies tend to do better than expensive companies, et cetera. Those are just two that we're looking at. And then what you're doing is you're maybe using several different metrics for each of those drivers of expected returns to kind of average out or come up with some sort of ranking for that specific metric.
Exactly.
And then obviously each company has to go through maybe 4 or 5 filters of drivers of expected returns for it to be a favorable position to be in the portfolio.
We'll make a quant out of you yet, Ryan.
And so yeah, what happens is when we buy a stock, it tends to be in the top 90th percentile, right, of all those different metrics, right? And then when it's no longer in the top third is when we're selling it. There's a couple tweaks for that, but I'm not going to bore you with that right now. But that's the general philosophy, right?
That's pretty straightforward. Is there anything else that you would want to add on to the, how it's built or how it works side?
I mean, if you look at it compared to the market, it's really interesting. So the market is trading right now, the S&P, for example, is trading, 25, 30 times current earnings.
What does that mean?
So how much price you're paying for earnings, price to earnings ratio, okay? It's just a measure is expensive or inexpensive. So,
so 25, is that high? Is
25
that
to 30 is higher than normal. Probably
Which
the market
means that it's probably overvalued.
Well, I don't want to say overvalued. It's more expensive than normal.
Okay.
Yeah. And our portfolio is under 15 times earnings. So our portfolio is very inexpensive compared to the market. What's interesting is the profitability is very similar. The yield, the market right now yields around 1.4%. Our portfolio is closer to 2.5%. If you look, it's very diversified. So when you look at it, theoretically, what should be in the portfolio is in the portfolio, and those ingredients should lead to higher expected returns over time.
The only thing that you didn't maybe fully explain there, I think you hit on it very briefly at the end, was the risk. So I guess what's the risk of our portfolio? What metric do we use to measure that risk, and how does that line up to the overall market?
So you can use beta and standard deviation, but in general, you're probably looking at 5-10% less risk maybe than the market.
So you have 60 something stocks in there, and you're saying that it's just as diversified as the overall market and less risky?
I'll let Nick kind of talk about the diversification. It's very diversified, but it can't be as diversified as the market. There's 10,000 securities out there globally, and we have 68.
Okay.
So think of diversification as there's diminishing returns to diversification. I think the research shows when you have a 20 stock portfolio, you've gotten 60% or something like that of the theoretical, mathematical maximum benefit from diversification. Okay. You can continue adding stocks and getting a little bit of a better benefit over time, but that benefit from adding securities diminishes over time, right?
Got it.
So we've tried to set, using kind of data and what the research has shown, this kind of 70 stock is a good balance of kind of having enough to get the maximum diversification benefit in terms of its
sacrificing
impact.
returns.
Yeah, exactly, while still preserving the optimal amount of return. Because remember, in our stock strategy, we're not trying to be diversified to the whole market, because that would include a bunch of stuff that's very expensive and not profitable. Sure. For example, we want to be diversified amongst the securities that have the characteristics that we're filtering.
Okay, so
let me add one thing that. If you're looking at the U.S. market only, 50 stocks gives you about 90% of the diversification as the whole market, right? Mm-hmm. And so why we use 68 is that we include some global, so we wanted to have a little bit more than 50. That's all it is.
So and trust me, if anyone wants to see the math, we can demonstrate it for you. You just for the podcast, you just have to take our word for it. But there is a lot of data we can show you.
I'll be glad to send you a bunch of research reports.
The moral of the story is that you're striving for diversification, and you certainly are achieving that. I mean,
yes.
And then the risk is, you would say, lower than the overall market.
Yeah, I mean, normally it should be lower, yeah.
Got it. Yeah. All right, so and I've actually had this question before. I'm just curious what your thoughts are on this. So we refer to it as a proprietary stock strategy. I mean, if you think about it, by definition, it is. We manage it in-house. It's something we created. But do you think that the use of the word proprietary is just like a fancy word that we're just slapping in front of that? Or do you really think that it is proprietary? Do you think that it is unique? And if so, what makes it unique?
Yeah, I mean, in the RIA space, certainly, I'm not familiar with very many. I can't think of a firm on the top of my head that uses a strategy like this. So I think in that sense, it's very unique for us to be able to offer our particular niche client base this type of quantitative strategy. I think typically the firms that are doing this kind of work are much larger and more geared toward an institutional audience in a lot of ways, or customer.
So when you compare that, just expand on what the RIA is compared to that institutional.
Yeah. So sorry, an RIA would be like a planning or investment advisory firm that's mainly focused on working with individual clients and families.
Okay, more of like the retail investor.
Yeah, institutional side would be more like pension fund or endowment. So think like a university endowment or a big foundation or something like that is investing, huge sums into investment professionals and resources. And I think this type of quantitative strategy typically has been run in that world more than in the investment advisor world for individual clients.
So correct me if I'm wrong here. I don't want to put words in your mouth, but I know, given your background, you were in investment research before CFA, so you obviously, studied this stuff a lot. You came from a previous RIA firm, so it sounds like what you're saying is that this type of investment approach is more something you would see on the institutional side, not necessarily like the retail wealth management, retirement planning side of the business.
I'll put it one better. I would put our stock strategy up against, any kind of, in terms of its objective, comparable strategy, whether it's an advisor running it, an investment firm running it, a hedge fund running it, and over 30 years, I think, hopefully we beat them all, but I would hope to be in like the top 10% or top 20% of performers. I can't promise anything, but that's where we're at competitively.
So bringing that in, for lack of better words, I guess, like bringing that, institutional side, like, serving as kind of like that bridge that brings Wall Street to Main Street. Do you think that that's unique? Do you think that that's a value add for clients?
Yeah, the good parts of Wall Street, I'll say.
But I'm just trying to make it like an analogy of like the institutional side, which when I think of the institutional side within finance and investing, I think, it's really something I just don't have access to. Yes. I'm not an institution. I just don't have the access to that level of research or those offerings. But it sounds like you're saying that this is kind of a good way to bridge that gap, bring the institutional side over to the retail side.
100%. I think it's an institutional quality strategy that is being made available to individuals and their families.
And we're getting institutional data. I mentioned 2 data sources. Downloading 5,000 companies' data for 5,000 companies. We have the data. It's a matter of how to use it intelligently.
Anything else, Ron? Anything else that you think makes this unique? Or I guess if you can't think of anything else on top of what Nick said, I had another question, which is, if you guys believe in this so much and you've worked at different firms in the industry and you think that this is an opportunity, why aren't more people doing this?
So, I think uniqueness, we've covered it. It's just I had kind of like this moment where all of a sudden I had clarity, and instead of doing these absolute measures, we're saying, hey, I won't consider buying a stock that's valuation, the price to earnings ratio is over 30. I just said, hey, if a company's growing and is very profitable, it's okay to pay up, right? So I did this percentile ranking, which was very, very unique. Usually you don't see it that way. But what's great about it and what's a problem is that it's hard to scale. Like for a large institution that was trying to put billions and billions of dollars in it, because each stock is equally weighted. So you could have something like Google, which is a very large company, very easy to buy, and you could have a mid-sized company that maybe the market capitalization, that means it's what it's worth on the market, right? It maybe is 5 or 6 billion, right? So it's harder for us to handle a ton of money as compared to a regular index like the S&P 500 or the Russell 1000, because when you're buying that, most of your money is going into the largest companies. So for example, if you buy the S&P 500 today, about 35% of your money is going into what they call the Magnificent Seven, those 7 stocks, right? So that could be good or bad, okay? But in general, they can handle a bunch of money because most of your money is going into very liquid, super large companies. Ours, because it's equally weighted, can't handle as much money. So that's why you don't see it with large institutions.
So a more pedestrian reason I think you don't see it more in our world of advisors for individual is that firms just don't want to invest in it. I mean, it takes
time and money.
Time, energy, the data costs money.
Then you have to hire the
then
people
you have
that
to have
can
someone
actually
who knows how to manage
the
it.
acumen to know what's going on and be able to talk about it with clients, et cetera.
Yeah, not to diminish what Ron said. I just think it's another reason.
So one question there, because I understand everything you're saying, but I don't know that the point was maybe elaborated on enough. So what does the equal weighting have to do with scaling it? I guess, could you just explain a little bit further, like why that would actually make it hard to scale?
Yeah, so let's just pretend it's, a 100 stock portfolio, right? And one stock is NVIDIA, right? So huge stock, easy to buy, very liquid. But you have another stock that has a market capitalization of $5 billion. There's not as many shares, not as much volume to trade. So it's just harder to trade. That's all it comes down to. And so because we don't care if it's large or mid-size or anywhere in between, we just compare company to company, right? So it's harder to buy more of those mid to large, not super large companies and scale it. Whereas, again, the S&P 500, most of your money's going into the super mega cap companies, easy to trade.
Okay, that makes sense. Let's, I guess, transition. So I know we've been talking about a lot of like what makes it different, what makes it unique, how it works, why Ron started it in the first place. What are some of maybe the drawbacks or the risks that you are educating your clients on, maybe before they invest in it for the first time?
It's different than the market. If you want to talk a little bit about tracking error.
Yeah, no, so we talk about risk in a couple ways. So we've talked about risk in this conversation a lot in terms of standard deviation or volatility, but really that just means like how much the portfolio fluctuates over time, up and down, because that can be scary, right, when you have wild swings. There's another concept that's related, which is called tracking error, and that's basically a measure of how different the returns of the portfolio are versus the market. Like, someone wakes up in the morning, they look at their returns, they look at the S&P 500, and everyone wants to beat the market, or everyone wants to be up a lot when the market is up, and no one wants to be down ever, right? Yeah. so
relative on the way up, absolute on the way down.
That's a better way of putting it. Yeah. So for someone who is constantly comparing their portfolio every day, say, to the S&P 500 or whatever index or measure they may pick, they're going to be frustrated, like if they're a little behind in the stock portfolio. Yeah. And with a 68 stock portfolio, I mean, that's going to happen. And sometimes it can happen for months or a couple years even. So I think you have to be aware of the fact that like you're owning a strategy for a long-term period as defined by multiples of years. And you have to be comfortable with the fact that the strategy does what it does. And part of that means looking different from the market. And for some people, that can be uncomfortable to the point where it's not a good fit for them, even if it's a good fit in other ways for their portfolio. And Ron, can you talk about, because you've spent a lot of time thinking about this, how we think about like our different ways of building portfolios depending on the client?
Yeah, so we have one belief, right? We believe in these factors of higher expected returns and risk. But in way of implementation, we can do it through an exchange-traded fund portfolio, very diversified, 10,000 or more stocks. And all we're doing is we're biasing the portfolio towards cheaper and profitable
Those
companies.
Drivers that we were talking about
Those
earlier.
drivers, right. That's one way, okay? The other way is a stock portfolio, 68 stocks, really, really focused on those drivers, should theoretically have higher expected returns, reasonable risk, all that. Yeah. But we can also combine the two together. Okay?
Understood.
So by combining the two, you have a base layer of diversification, and on top of that, the focus of the stock portfolio. So for most of our clients, by the way, that's what we do.
Got it. So, so the risk that Nick covered first was tracking error, meaning that if, let's say, you're comparing Wyze Design Direct to an inadequate benchmark like the S&P 500. And if you're comparing that every day, if you're looking at your investments every day, at some point you're not going to be happy.
Yeah, that's a thing we should work on first. Yeah. Just as an example.
But two, if you're comparing it to an index, especially one that isn't, accurate in terms of how you're comparing, you'll probably be unhappy at times as well. But what you're saying is that the stock strategy essentially is laser focused on these certain drivers, and the exchange traded fund portfolio is biasing those drivers, but they're still built off the same beliefs.
Exactly.
Okay.
And what normally would happen is that when the market becomes very, very focused on a few names, for example, you used to have the Nifty 50, I think that was back in the early 70s, right? Those 50 stocks got really, really expensive, and the future return of those stocks was horrible. Then you had the tech bubble, right? Those stocks got really expensive. For the next 10 years, people don't realize the S&P actually gave a negative return for 10 years, okay? And so we're likely to look less intelligent when environments like that occur, right? Okay. When it's like a no-brain, everyone goes into these few stocks, they get really expensive based on their fundamentals, we're probably gonna lag, okay? But on the backside of that, normally there's a correction, we will be less exposed. And so it's really a dynamic process. Like, for example, a couple years ago, there was about 30% of the portfolio in tech. Now it's way less than that because tech has really run. So it's really just a common sense approach.
Schedule your complimentary review with Ryan and his team today. Just visit them online at wyzewealthadvisors.com or call 724-271-7019 to get started. That's 724-271-7019 to get started.
So, so outside of the tracking error in terms of risks or challenges, is there anything else that you guys would want to bring up? Something that I think of is, this is a strategy that's definitely not set it and forget it. You're not just putting your money in and just leaving it there. So there's probably some trading involved. So is there some sort of tax impact from that trading? If you're really, giving an institutional like investment approach, but on the retail side, like, is this expensive to use? Is it more costly than just investing in a mutual fund portfolio?
So, taxes, fees, all great questions. So first of all, because there's trading, you're trying to buy something low to sell it higher, there'll be taxes. So it makes a ton of sense in an IRA account where you don't have to worry about paying taxes on those gains. In a non-IRA, I'm hoping that I'm expecting that the returns are better than the ETF portfolio, but they'll be less tax efficient. So it's hard to see which way is better. Okay, we know that it'll be less tax efficient. We think it'll be better returning, but after tax probably really similar. Okay.
So there's a little bit of a tax impact in a non-retirement account that needs factored in.
Yeah. The fees. Some people will say, active management is terrible because of fees, and that's largely why a lot of mutual funds will underperform. We only charge 0.1%. It's like the cost of an index fund. So the fees of this are very, very, very low. That's not going to be a factor. So it really comes down to...
Not to mention, too, that you can trade these stocks now commission-free.
Yeah.
So you're not, every time you buy or sell something...
Right. Now, what I would say is, but part of it is based on, do you have enough money? Because you need at least $250,000 to $500,000, depending on, your stock to bond split and everything. So the larger accounts make sense in retirement accounts. But it also, you have to be okay owning individual stocks, seeing the trades. So if you want something that's really, really, really simple, the exchange traded fund portfolio is better. If you don't mind seeing a little bit more of the details, then the stock portfolio is fine.
Okay. I think that's a good segue into the next question that I had. And I've actually seen this from experience. So when I first started in the industry, I worked at Vanguard, and they had a wealth management service for clients there. And it's different now, but at the time, they were really leaning very heavily on kind of like a 4-fund own the market investment approach. Now I know we're focusing on equities or stocks for today, so I won't go too deep into the bonds here, but basically what they did was they would use 4 of their mutual funds. They would use a total stock market, which is just US stocks. They'd use a total international stock market fund, which is international stocks. And then they do the same thing on the bond side. They'd use a total bond market for US bonds, total international bond. They'd maybe go like 70% domestic, 30% international between those four funds. They'd call it a day. So pretty simple, pretty easy to understand, pretty straightforward. How does a strategy like what we're doing compare to that?
Let's dissect it first of all on the bond side, okay? So I use Vanguard index funds, Treasury and one from WisdomTree, but I use bond index funds, but I also use something called private debt that has a much greater yield. So our portfolio should have similar types of risk as the broad bond market, but the yield should be about 1% higher, right?
Okay, got it.
So the private investments can help a lot there. On the equity side, there's nothing wrong with that portfolio at all. Our exchange traded fund portfolio is very similar to that in that we own basically the market, okay? The only difference is that we bias the portfolio more towards these drivers of expected return, profitability and valuation. And so we, if you look at the past data, that's outperformed. We think that will continue to go forward. But it's not too far off. It's kind of between active management and passive. It's kind of in between the both because it has these biases, right? And the stock portfolio is just, think of it as one is a scale, right? You're overweighting the good, underweighting the bad. And then think of the stock portfolio as you have a bullseye and you're trying to aim for it, right? You're trying to get these 68 stocks that are like basically showing you the best attributes. That's all it is.
So the difference is when following the approach that we use, what you're doing is you're setting yourselves up for better risk-adjusted returns. And really by doing that, you're targeting, which is maybe where the Vanguard approach that I've described in this episode would be lacking. You're biasing or targeting those drivers of higher expected returns, which Nick, you covered and actually gave hard numbers earlier. The proof is in the pudding. That has led back from the 60s up into the mid.
Go back to the 1920s.
It's led to better results over
exactly.
the long run.
Yeah, that's what we're striving for. Exactly.
Got it.
Yeah.
Anything else that you guys would want to add in terms of the proprietary stock strategy or Wyze Design Direct? Anything?
The only thing that I would say that is kind of a nice thing, I found in my career that sometimes for a certain subset of clients, like seeing individual stocks makes them feel more connected to the investments in the portfolio and more engaged with it, which can be nice for some people. And that's something you don't get with the four-fund portfolio, especially because we're doing this at a fee that, like Ron said, is comparable to an index fund. I mean, a lot of the issues with strategies like we're running, if we charged a lot more money to run it, I don't know, but we're running it at a very similar cost to these much cheaper, more diversified investments.
Why charge a fee on it in general?
Well, I mean,
Ron needs a boat. He needs boats.
yeah, exactly. No, there's so much time. We had to get an outside trader. We have these outside vendors for data, all the time involved, and it's still a lot less expensive than our exchange traded funds portfolios, which are very inexpensive to begin with, right? So it's just trying to not lose as much money on it is what it comes down to, right?
So not trying to make money off it.
Oh,
really
no,
just cover
some of the cost, right?
Yeah.
And there's a lot more that goes into it, like our time and effort. One thing I wanted to say too is, put my money where my mouth is, right? So my IRA and my wife's IRA, until about 2 weeks ago, was 100% in the stock strategy, okay? Mm-hmm. Now, 2 weeks ago, I changed it, not because I have a crystal ball. I had a rollover, and so with the new money, what I did is I put some private investments, about 20%, and the stocks about 80% of the portfolio. The private investment would be like the private debt, yielding 10%, private equity, and I think that will help just with our portfolios, my wife and mine. Just kind of balance it out, but again, most of it's in this portfolio, so I live and breathe it.
Yeah, well, one thing that I want to make sure that we also get across is, regardless of how passionate you guys are about, the markets and this strategy, investment management or Wyze Design Direct is not the only thing that we do.
It's the only thing that matters.
No, our beliefs are pretty straightforward. We think that, and we can speak from experience. We've covered, between the three of us, we've covered a lot of different firms in the industry, and we've seen that a lot of firms that focus on, retirement planning tend to be light on investments, and vice versa. A lot of firms that maybe lead with investments tend to be light on retirement planning. And we just don't think that really cuts it. We believe that you can add a lot of value on the retirement planning side, but we also think that you should add some value on the investment side as well. And our clients really resonate that with that. So our philosophy is add value in both areas, not just one. And that's what we're trying to do with that. And I think that, and you guys I'm sure would agree, I think that this approach has been doing that for our clients.
Absolutely.
Perfect. Well, if you want to further explore, not just the investment approach here, but really all of the services that we offer in a comprehensive manner, all you have to do is go to our website, wyzewealthadvisors.com. That's WYZE. Click on the free retirement assessment, and then you can schedule a 20-minute introductory call with a member of our team. The whole purpose of that call is to see if there's a good fit. Assuming there is, we have a simple 3-step process where at the end of it, you have fully evaluated our services and you have a financial plan that you get to take home with you before determining if you'd want to work with us in an ongoing manner. Hope you enjoyed.
This episode's content is for informational purposes only. Opinions expressed herein are solely those of Wyze Wealth Advisors, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by our firm as to other parties' informational accuracy or completeness. All information or ideas provided should be discussed in detail with an advisor, accountant, or legal counsel prior to implementation.